Hi, good afternoon. Hi, everybody. Welcome to Coherra platform and to a conversation today about real estate. I am Søren Hestrup. I'm the founder of Coherra, and I've been looking forward to today to welcome John Cascarano and Rich Turaski for a bit of a masterclass and introduction to the U.S. real estate industry. For full disclosure, I'm new to the real estate business, despite being married to an architect that are building and designing hotels and restaurants all over the world. But I've been running a hedge fund for 15 years myself. I feel I have a good understanding of the economics, but definitely need some practical lessons here. So it's a pleasure to welcome you guys. Um, and I'm looking forward to hear more about this niche that you have found. It's really impressive what you have built over the last 2 years, and we're looking forward to learn more. I know that it's the niche as an RV and camping side focus that you have. I think it might be new to many European investors. So at some point, I think we should also go through the definition of the RV parks and how they are defined. But initially, I think it would be great to understand a bit about your background, your way into real estate. It's not something you just dump into one day and become an operational manager the next day, or an expert at least. But so maybe you can give us some background. John, how did you get into the real estate business?
Sure. So I am, as I like to say, a recovered commercial real estate attorney. I started practicing law back around 2005, so almost 20 years ago. I practiced law at a big law firm. Then I left, joined a business, helped build and scale and sell the business. Started another business, sold that business, and then eventually went back to practicing law and was trying to figure out what the next chapter or project I would work on would be. And I had clients buying mobile home parks, RV parks, all classes of real estate, shopping centers, office buildings. And I just kept coming back to the mobile home park and RV park space. And in RV parks, I saw people getting higher returns, but nobody really consolidating the sector, like trying to scale those efforts. And I saw qualities that are often characteristic of people generating significant wealth, meaning there's a sector that's very fragmented and the branding is inconsistent. So I saw an opportunity, and my wife and we bought the first one. So we at first it was just an investment. We bought a park ourselves and learned that way, and it went really well, and we still own it. So then we did another and another and another and started raising capital to do more. And my early thesis became validated, and I said, holy cow, there's a big opportunity in this sector. And that ultimately led me to Rich and forming partnerships and bringing on more sophisticated investors and team members that could help build this dream and hopefully get us all to a great exit someday.
Fantastic, interesting, thank you. So we went from law into property and the operation of a RV park. I can imagine the difference here. But and Rich, are you also a recovering lawyer or?
No, John. I tell everybody John's the smart one. I started my career 32 years ago, dialing for dollars, as they call it. So I got into commercial real estate right after I graduated from college in the Midwest. I was born and raised in the suburbs of Chicago. And I got a job with a commercial real estate company, and they were entrepreneurs. They had already started acquiring real estate, mostly industrial, in the suburbs of Chicago. And their preaching was brokers die broke. So figure out a way to build passive income and net worth. And the way that you do it is by owning real estate and not brokering real estate. So I bought my first building when I was 24 years old. I'm still surprised today that the Northern Trust actually gave me the loan. I then built my first spec building, because once you're a real estate investor, the next addiction that you get is to become a real estate developer. So then I built my first spec building as a developer when I was 25. And then we had the benefit of being in Chicago that, we have more Fortune 500 companies based in Chicago than anywhere else in the country. So, big companies, big buildings, big transactions, all the major institutional banks, institutional pension funds, and insurance companies, if they're not based out of Chicago, they're certainly present. And a lot of the private real estate companies in the early 90s were, had significant challenges with financing, just, not too dissimilar than what's been happening the last couple of years. And so, the decision was, you were either going to go public or you were going to go broke, because banks didn't want to really readily lend to the space at the time. So I actually worked with many of today's largest publicly traded real estate investment trusts through the process of taking them from being private to being public. And I would assist them in aggregating the assets that they would create the public vehicle with. I ended up becoming one of the youngest partners at the firm. I stayed there for 10 years. And when I left, we had, we owned more than 90 buildings. We had a construction department. We had a property management department, an asset management department. We probably had 50 people and 15 brokers doing third-party transactions. And I left to start my own investment in finance business as Capital Realty. And, we were doing high net worth and institutional co-investing. And I went and started aggregating, very similar to what I'm doing with John now, where we would buy one-off transactions in the $2 to $25 million range. We would then assemble them together. We would then go out and get institutional type of equity and debt partners. I raised, probably a half a dozen institutional co-investment funds where we had commitments, several hundred millions of dollars to buy and develop property throughout the Midwest, where we were primarily focused. And I did a large exit to an institutional company out of the East Coast and became partners with them. And, I co-invested, $100 million worth of my own assets with them. And several years later, we sold. It was one of the largest transactions in North America that year. And we actually sold the entire portfolio to the Abu Dhabi Investment Fund. And it was tens of billions of dollars. And then I was actually approached about 3 years ago, where we met one of our other partners, Eric, and we were founding investors in doing public SPACs, where you take private companies and you take them public through an IPO. And that SPAC craze lasted from about 2000 to 2003. We did, close to $2 billion worth of private to public IPO mergers. And then after that fun had happened, I started getting the itch to get back in and really focus on real estate again and doing a private to public or institutional type of transaction. I was putting together all the documentation to actually do my own RV park REIT. Growing up in Chicago, we had the benefit of Sam Zell, who is probably well known as one of the most successful real estate entrepreneurs in the country. A lot of people don't know he started out not only in apartments, but he put together RV funds and mobile home parks, and he took that company public, and it now trades as Equity Lifestyle, and it's probably worth a market cap of north of 15 billion. So I knew there was a tremendous amount of hidden returns in an asset class that isn't overpicked by the institutions, which create the cap rate compression and, results in lower yield. So I was in the process of putting that together. Somebody referred me to John, and I was thoroughly impressed by the fact that, here's a guy who didn't start his real estate career like I did. He was a lawyer, he was advising clients, and he went out, started buying some things. And I think it clicked for him when he saw his year-end tax return, and his wife, who's also an attorney, said, "Hey, how are we making all this money, but we're not paying a lot in taxes?" And, that's the beauty of owning what we own, and you get the depreciation, which substantially offsets the income. So, our fund is specifically designed to pay double-digit cash-on-cash returns to our investors. And then the depreciation at the end of the year is just an additional bonus. And then over a 3 to 5 year period of time, we're really hopeful that we can, produce a really nice risk-adjusted return that investors will continue to invest with us. And so John and I, when we met, we said, hey, I was going to go and build my own public RV REIT. John had not only bought 25 RV parks in 2 years, but he built an amazing platform. And that wasn't what gets me excited. What gets me exciting is finding the deal, structuring the deal, putting together the partnership and the capital stack, aggregating the assets. And then, over my 30 years, I've done multiple exits. So, certainly like to do that part. And, having John as a partner now, my legal fees are a lot less than they used to be. And that's how we came together. So I tell people I was the chocolate and he was the peanut butter. And now we're selling Reese's peanut butter cups together.
All right. Thank you so much, Rich. So together you have a lot of experience in obviously not only in structuring and also operational, I guess. But coming back to something I opened up with is the definition of RV parks. I did some home research, and it brought me to a number that there was about 11.2 million RVs in the US. That the number has increased quite nicely in the last 10 years. That we see a split demographic of people under 30. So the average is, I think, about 32, but there's a lot of young people that are starting to buy RVs, and there's a lot of boomers that are retiring using RVs. But how the RV parks, are they different from other investments? Are they different from the camping grounds that you operate? And what is the definition of it? I think that would be really good to understand.
Yeah. So
go ahead, John.
I'll start, and Rich you can elaborate further. But yeah, RV is recreational vehicle, and this is not exclusively an American phenomenon, but it lends itself very well to this country, where back not long after there were cars, people started exploring the country. It opened up this world of possibilities, and there's a whole history to the RV sector and camping. And there is overlap in the definitions of campground versus RV park. But imagine just being able to go anywhere, work anywhere, wherever one day you can be in Montana, the next day you could be in Colorado, spend the night, drive in somewhere, plug in, go on a hike, come back, spend the night, go somewhere else the next day. That's kind of it's an American value, really. Freedom, independence. These are fundamentally American things, not exclusively. We didn't invent it, but it does lend itself to big open spaces throughout the country and that ability to travel. And that's kind of the basics of the history. And an RV park is really just that place where you can pull into that has the infrastructure, utilities, bathhouses, facilities there, amenities, pools, and over time you've seen great variability in the sector of what is at an RV park. Everything from resorts where you have full bars and swim up pools where you could swim up to the bar at the pool, to very basic places where it may be a contractor park in Texas where guys working on the oil field are just need a place to stay. They don't live there. They're just there. They just need somewhere to plug in and have a bed, a bed in a shed type of setup, and that's it. And there's within it, there's all these different subsectors of people who are campers or patrons or customers of RV parks. That's the gist. A lot of what we're looking for and what excited me about it is that we're buying strategic land. So an RV park is really an infrastructure with all those amenities, often in really great places, on a lake, near a national park, near a state park, right off a highway between some entertainment draw. There's really a draw, and it's just kind of like location. That's one of the qualities that makes an RV park great, is it's just a place that people stop for whatever reason. And when we buy these, we're a lot of times looking for existing RV parks where we could see those characteristics in their financials. And that's the gist of what an RV park is. But you flash forward now, and then I'll let Rich talk. You can have wireless internet wherever you go on the road. Tesla and Elon Musk, they have their technology, but at many of our parks, the number one amenity that people want is strong Wi-Fi. So when we come in, that's one of the first things we do. We go through the whole park. We have a guy that tests the Wi-Fi throughout the park, but that really allows you to work from anywhere. And that's a lot of the reason why young people are getting into RVing so much, is because of that freedom to have like that flex lifestyle, work from anywhere, live anywhere, go anywhere. It's really kind of cool, but that's the gist of the RV park sector.
Okay, fantastic. Thank you. And Rich, you have anything to add?
Well, what I was going to mention was, the RV parks is really a subset of multifamily housing. And think of the RV park as the hotel, where a lot of the times you'll see advertising for RV parks as well as mobile home parks. So RV park is more of the hotel, where the mobile home park is more like the condo. And the RV aspect is definitely more transient, and that's really why you get a premium for what you charge. It's the difference between buying the car versus renting one at Avis, when you're traveling. One thing that really certainly became evident was COVID really played a big part in the exposure that everybody had. There's many people that I know that always have a story about going camping when there was, they were a kid with their parents, whether it was to Yosemite or to Glacier National Park, and they took the summer off and they rented an RV or a mobile home. And, there's not too many people that have a bad story to tell of their camping experience. But COVID definitely took it to another level, and people were able to experience the enjoyment as well as the flexibility of using an RV to stay at these parks across the country. And because of technology and the advancements, everybody started, working from home. And, working from home is a very broad term. It's really working from where you can ever get a Wi-Fi signal. And so that's why I think there's been such an explosion in the growth in the business, that you not only see in the summer times and around state parks and national monuments and, things like the Grand Canyon, but, people are working from these locations because it's a subset of housing and it's affordable. And somebody can stay on an RV pad in a location for $50 a night, or can stay at a premium location for $150 a night. And that's still significantly cheaper alternative than staying in a hotel or doing an Airbnb type of a situation. So I think those are things important to mention about why there's growth in the industry and what's kind of really spawned it.
Interesting. Very interesting. I remember, related to COVID, there's a stock listed in the US called Camping World, I think.
Sure.
That does RVs. And did tremendous. I mean, really had
Marcus
tailwind.
Lemonis, another good Chicago.
Yeah.
Yeah,
Okay.
it's from Chicago.
So I understand. So you've been building this vehicle and collecting this. How many RVs in camping site now?
We have 26 properties in
26 properties
in 10 states right now. We'll close on at least one more within the next 11 days.
Okay.
First, and then we have a pipeline, we call it, of properties that we're looking at evaluating. And
okay. Fantastic. And I saw that you have collected, I think, value of about 150 million in real estate right now. How big is the market? We can start with, okay, how concentrated is it? What's the geographic exposure you've chosen, and where do you want to build this?
Depends. There's different ways we could slice the market and answer that. It's definitely a multi-billion-dollar market in terms of attainable market for us. Our niche has been really focusing on properties that are oftentimes, we'll call them value add properties, where there's existing property, a history of profit and loss statements we could look at with some value add upside, where we know we could come in and execute on our playbook and increase the net operating income or EBITDA. That's it. That's the playbook. And they're everywhere when you start looking. And if you come to the US and drive around, you may never see them until you see them. And you're like, oh my gosh, off every interstate exit, they're everywhere. And there's a significant percent of the population living and traveling to and from them and using them. So it's a multi-billion-dollar attainable market is what I'd say. It's much bigger depending on, you start talking about the different segments and kinds of RV parks, and there can be crossover into mobile home parks and other sectors, but it's a multi-billion-dollar market. I'm in Nashville, Tennessee. So the portfolio really started here, and operationally we've expanded into surrounding states. So pretty much Tennessee and every state touching Tennessee, we have a property. Arkansas, we're adding a property soon. So there's some concentrics. You draw an 8-hour radius around where I live, we have a park almost in any direction. We also have two parks out in Montana, which actually are two of our best parks. And the first one was just by chance. But we looked at it, and because that park had scale where we could hire a good team to manage that park on site, and it's seasonal, there's other characteristics of that park that made us think we could execute on it. And we got a great deal on the park, and it's right near Glacier National Park, which is one of the top national parks in the United States. Beautiful. It's worth going to if you come to the United States, up almost into Canada, and just an incredible place. And this is right near the entrance. So that's what we want, where there's inherent value to this land. There's nowhere to stay. It would be difficult to rebuild that. The approval, permitting process, the availability of contractors in a place where it could be very, very cold in the winter makes the build season small. And so it's a place where we have this value inherent in the asset locked in, and people need places to stay. I was taught the best thing in marketing is a starving crowd. You want a crowd who needs what you have. And that's why that was a good purchase. And then that went well. So we ended up buying another one an hour and a half away. But a lot of this is we have to be mindful of just ability to execute operationally. And we now have over 90-person property management team. So another question people might have is, why has no one done this? And it's operationally oriented. that was one of the big solves. And one of the things, I'm an entrepreneur, even though I'm a lawyer, I love building and the energy of creating something and building a team. And over the last 2 years, that's been a lot of my time, is just spending building a team, good leaders in the right places, good park managers, district managers. You get into facilities management, maintenance. We're really running both a housing business and a hospitality business kind of in one. But we've built that, and now we're at a place where we're starting to be able to acquire assets more quickly because we have a leadership team in place and can execute.
Makes sense. Makes perfect sense. So how do you scout for these properties? Because I guess when you're not buying them in bulk, and they are not just around your neighborhood. I guess many of them may also be family owned, or
yeah, that's true.
What's your process here?
Yeah. So, and Rich also, he brought some background to this too and helped us improve, I think, in some ways here. A lot of it's making phone calls. A lot is out there. Like you can see them on just Googling park, going geographically and just Googling and seeing what's showing. Not all parks are even on Google, which is mind blowing. And many parks don't even have websites, but most you can find. And there's different channels. We'll look at deals from brokers. There's obviously brokers in the space, and it's kind of becomes a small world. We know who they are, so that's one channel. Another channel is just word of mouth. People know us at this point, so they'll send deals to us. Another channel is I have a retired police officer, 30 plus years, oversaw 110 law enforcement people, and he's very good at talking to and negotiating with park owners. And he has some folks under him making calls, just calling park owners every day. They'll in 1 week, they may call 100 parks. So it's pretty intense, and we're gathering data on those parks. Another channel is relationships too, which Rich has brought too. There are and we're starting to look at other operators' portfolios. So that could be a way to go faster. And we're looking at those. There's a lot of folks out there that may own a couple parks. So sometimes you can pick up a couple in one swoop. But acquisitions it is really kind of that lead, making calls, just going through 100 deals to find one good one sort of exercise.
All right. Fantastic. Thank you so much. And so I think you have syndicated investments from about 400 investors by now. I mean, which is really, really impressive. Congratulations. And you're distributing quarterly returns for the investors. How does the structure work, and how is the economics from the investors?
It follows a typical GP LP, some call it structure, where there's a waterfall in favor of the investors. And we, Rich and I, Eric, as the GP general partnership, we are incentivized to make the property perform, and returns above a certain break point. The better it does, the better we do. So typically there's a 7 to 10% preferred return, which in the waterfall comes off the top. So that has to be satisfied first. And of course, debt comes first. If there's a mortgage on the property, that's debt that gets paid. Then if there's distributable cash, that goes first to satisfy the preferred return. And then after that, there's a split, like usually around a 70-30 split in favor of the cash investors. And then if we beat a certain internal rate of return breakpoint, we can share more in that. It may go to 60-40 and then eventually 50-50 if the property performs.
Sure. Okay. And you mentioned if there's depth to it, how is the leverage structure? I mean, how aggressive can this be, or how conservative have you chosen to be?
Usually, usually we put about a 30% down payment, between 25 and 40% typically. Banks usually underwrite it as well off the cash flow. This is a cash flow play, so they'll look at the cash flow. Sometimes they'll consider the asset, but it's really a debt service coverage, DSCR loan. So they're looking at the cash flow. So there is some underwriting going on, on top of us on most properties.
Yeah.
Sometimes we can get seller financing, and some people call that different in different countries, but where the seller holds the note, and there can be tax advantages to them to do so as well, delay some of their tax impact. So sometimes we get that, and sometimes those terms can be favorable. Those can be 4 to 5% because and we'll negotiate that if we can with the seller. But usually there's a bank loan. Rates have been a roller coaster, but we've never done anything above. You want the cap rate to be above the loan interest rate. We've never done anything above 9%. The only reason we did that was the end of last year, really to capture the tax benefit, and there's no prepayment penalty there. So we knew we would refinance, but most rates are in the 6 to 7% range right now, and they've been coming down.
Yeah. So interesting. And if we look at the operational side, we discussed earlier, how big is the market, but I also know a little bit about operational sizing, that you get some benefits as you grow. That can be interest rates, payments, how the financial structure is. There can be some advantages in terms of operational cost, as you described. If you can have fewer people doing more or covering more sites. I guess there's also something to do with how attractive it is for you in an exit scenario further out. When do you qualify for, let's say, institutional investors to either co-invest, or I think you described it a little bit in the beginning, Rich, that some other operators or yourself earlier had built up portfolios and sold it off to institutional investors, or the gentleman, I forgot his name. I think he passed away this year or last year, right?
Samzel,
exactly. What a man. And
I actually I went to Michigan for law school, and I went to the business school and heard him speak in a pretty small room. And I had no idea who he was, but by the end I did. But he made his initial fortune where I went to law school, in the college town. And this is what he talked about. All the houses around the college now are student housing, but he made his first fortune starting as a college student, buying these houses, which were owned by families, and bit by bit converting them to student housing. And he built a big portfolio, and then I think sold and went to the big city of Chicago. But just a side story that I went to that speech. I was also in law school. I did underwriting for a family office, and they told me, you need to go to hear this guy speak. So.
Oh, fantastic. Yeah. I just listened to a podcast with him, and I actually don't listen to podcasts, so it was on YouTube. But he gave like a couple of hours interview and masterclass, and obviously a long career. And he certainly also have been very smart in structuring it, right? Depending on where we are in the investment cycle and the environment you're in. I think he put pride to that. Exit was just as important part of being in the property industry as it is, of course, to operate it diligently and have a strong name in the market, right? And being respected. So
to add to what you're talking about, and I too, growing up in Chicago, got to know Samzel as a friend, and actually one of my lawyers was his in-house lawyer. So early in my career, I was paying attention because he was definitely one of the forefront leaders in real estate in Chicago. But what's super interesting and super important for the investor to know is it's not just about how good the asset is. It's about how good can the asset be as what we would refer to as a tax shelter, by having the benefit of depreciation to offset the ordinary income that you're taking out of it, so that the true cash on cash to the investor is much higher than they can get in investing in any other classes. And, you know, Sam, when he sold Equity Office, which was a public company, I think he sold it to Blackstone, and he was the largest owner of Class A office buildings in the country. What did he do with the money? Well, he immediately went to look for another business that had a tremendous amount of carry forward losses, so that he could offset all of the gains that he made just by selling all of those office buildings. And that's why he bought the Chicago Tribune, which is kind of famous because they also own the Chicago Cubs. So, you know, true to what he always believed in was not just how good is the asset, but how good is it as a shelter, so that you can actually have much more free cash flow at the end of the day to use without. Now, you're not going to avoid the tax, but you can certainly creatively defer it, and you can use the depreciation to help you defer it, and then further do creative investments through 1031 exchanges and things like that. But it's important to mention that here's the smartest guy, the biggest in the space, and he consistently in his own personal investing looks for investments that help with that depreciation. So the net result when you pay your taxes at the end of the year is much lower than if you just bought a stock, or, you know, if you just bought a franchise, or if you just, you know, bought some other alternative investment.
Yeah. Interesting. And
I mean, we have funds right now that we're telling our investors, you want to invest before the end of the year, because of the United States, the tax structure changes 12/31. It drops from, I think it's a 60% depreciation benefit down to a 40%. Now with Trump, there's a lot of, you know, noise around the fact that he might, you know, bring that back to the 60%. But, you know, we have a limited window here where investors can benefit if they invest into one of our funds before the end of the year to take advantage of that additional depreciation from the assets that we're buying now.
Yeah, it has a huge influence in the total returns, of course. So when we're talking about, okay, the structure, optimization of it, size is important. You know, what is the overall vision for Blue Capital? You know, how far do you want to build it? How and where do you really get the benefits from size? Are there some threshold that qualify for you to increase the optionality of exits or of operational cost reduction?
Yeah, I think when I first met John, he's a serial entrepreneur like I've been. I mean, I've had probably 30 other companies outside of real estate that I've owned. And, you know, one thing that I've learned in my CEO groups that I've been a part of, you know, wandering journeys are not always enjoyable. And to have a specific destination and plotting a course usually is a lot more effective. So we are in a clear destination. And John has built a portfolio so far of 25 assets, you know, valuation over 9 figures. And what we're going to try to do as quickly as we possibly can is to aggregate these assets across the country, get as close to 300 to 500 million of assets under management. And then the universe of exit opportunities get very interesting, because then we're having conversations now with pension funds and insurance companies and already publicly traded investment vehicles that, you know, they can't afford to go and buy a $2 or $25 million one-off transaction. They need to spend billions of dollars, and they would much rather buy a portfolio with a proven sponsor. And that portfolio is got to start in the 9-figure range. And most of the stuff that I've done over my career, to get the institutions involved, you really have to have at least 100 million worth of assets to talk with them. And then you get the really big ones at the $500 million mark. And then you really have something to share with the public markets once you're close to $1 billion. Now, there's obviously public companies that are trading at market caps in the $5 to $10 million range, but I'm talking about scale where you're not having to grow by doing the next transaction. You're growing because you have recurring revenue, and it's growing on an annual basis. And then those savings come that you talked about, right? John's starting to experience it now, that whether it's the cost of insurance and the carriers that are willing to insure, and simple things like Wi-Fi, the digital systems that are being put into these parks, they're tremendously expensive, but when you divide it over 25 parks, then it becomes very affordable. So, you can go down the list. There's dozens of cost savings across the board that we don't really have to do anything other than aggregate a whole bunch of assets together. And we're going to get interest rates from the banks that are going to be cheaper. We're going to get actual expenses that we incur at a lower cost. We're going to have, cash flow to be able to expand at these facilities that the local operators either didn't want to or couldn't afford to expand, when the most expensive thing has already been done, and that was getting the zoning, getting the entitlements, getting all the infrastructure, the roads, the sewers, the utilities. So we don't have to take a lot of risk and spend a lot of money, and we're buying legacy assets with historical financials. So we're not buying empty real estate and hoping we can find a tenant and hoping that our forecasted or expenses aren't over what our budget is. So it's a strategy of aggregation, and then we're going to grow it to $500 million in size. I mean, quite candidly, we're already dealing with a handful of other operators that I think John mentioned that, they have 60 million of assets. They have 100 million of assets. They have 150, and they know the benefit of being aggregated together to then go and get to that institutional market where money is cheaper and the values that the investors get that are involved in these properties are significantly higher on the exit.
All right. Thanks a lot. I see that we have now turned about 40 minutes, so I think it's close to what we discussed. We also have a Q&A. So if there's anybody who have interest in or have any specific questions, please feel free to post them. We have one that is already prepared. I know, John, you're a lawyer, so I'm certain that you will not feel comfortable with this question because it's related to taxes and whether some of the cash flow benefits that you have can be offset in the depreciation can be offset in other asset classes like in the stock market. But I will leave up to you whether you suggest that Brian will need to consult a tax lawyer instead. But the question goes that as a retail investor, in addition to the annual rate of return and cash benefits, would the depreciation offset W-2 income, long-term capital gains in the stock market, or K-1 long-term gains?
Yeah, I would. This is actually a common question, especially for folks in the United States. The loss would be a passive loss and subject to the passive loss rules. And yes, I am not an accountant. I'm a lawyer, but not an accountant. So obviously, fact check this. But the passive loss rules are structured by the IRS to prevent high W-2 income earners from not paying taxes. The loss would be a passive loss, but could be used to offset passive gains. What is a passive loss? What is a passive gain? There's nuance there to that. It's not a capital gain, so capital gains don't count. Those are their own kind of gain. W-2 income, no, with an asterisk, depending on your, there can be some nuance there, whether you're a real estate professional, whether you elect that status on your tax return. But presumptively, no, it's a passive loss. But if you had other passive gains, if you had other passive gains from other business investments or real estate investments, the classic example is you have a gain from another real estate investment, a loss from this investment, those offset. That's perfect. And sometimes people call buying a property like what we buy that has a big loss from depreciation the lazy man's 1031 exchange, which is where if you sold 1031 in this country is if you sold a property, you have a big gain. There's some rules around exchanging into a like-kind property to avoid paying taxes on the gain. Or you could buy a property like an RV park that has a big loss from depreciation year one that can offset that gain too. So there's nuance there. I'm happy to talk about it more offline.
Okay, fantastic, super. But I think I will just see if there's any more questions. But is there anything else? I mean, there's a wealth for me to learn still, but I think it's a really, really interesting niche you have decided to invest in. It looks like there's a huge opportunity still to grow it from geographically where you are and get into those benefits. I have one question, and that's more related to the land, because as you described in Montana and probably other places, you must have some very unique destinations. And are there limitations on what you can do with these lands? I mean, what you can build if you want to structure or make use of it differently, if you suddenly want to sell it to hotel, or you want to start to build apartments or something like that. How is?
Yeah, usually, there's wide variability based on the locale, but usually because we're buying an existing park, we're fine zoning wise for the current use. And usually uses like you're talking about would be better uses. So there may be a rezoning required just depending on the use. But I can tell you, like in Montana, we also have a bed and breakfast there. So that depending on the local zoning rules and regulations, a lot of times these fall into hotel would be permitted as well. Housing uses would be permitted. And that actually might be like an upzoning where the municipality would like that. If you went from and that was actually part of the issue with mobile home parks was it is now very hard to get approved to build a new mobile home park. Easier to get approved to build an recreational vehicle park, but sometimes there can be barriers if you're developing it from scratch. So that's why we really like ones where there's already a park there and we can come in and expand it. That's much, much easier. Or we can come in and add. We've never had any difficulties getting approved for those kind of value adds that we can do, or those, if you make it nicer to make it simple, you usually don't face any zoning issues. Some of the issues might be more around, septic or sewer capacity, utility infrastructure, water availability. You'll have to address those, but usually it's already there. On every park we've bought, it's there. So we're really facing the hurdle of adding capacity.
Soren, one thing I was going to mention that's important for our investors to think about, I had mentioned before, I've been in this real estate business for 32 years, and I've personally owned more than 100 properties. And so, I've bought almost every food group in traditional investment real estate. You buy a piece of real estate and you have a tenant, and your tenant has a short-term or long-term lease. And the reality is you hope he pays you in the first week of the month. So then you have the money then to pay the lender on the second week of the month. And then what you're left is usually the cash flow to distribute to the owners. Well, once you get into the real estate business as big as I got into it, then you've got, I think at one time we had 600 tenants. So as a result of having so many tenants in so many buildings, you find yourself getting into the collections business because not everybody, can afford to pay the rent by the first, and things got better, once we went to ACH and, you put people on automatic payment because we used to hear all the time, checks in the mail type of a thing. And there was this massive float out there. But getting into this RV space as heavily as I have, the beauty about being an investor in the RV space is when people book their reservation, they're typically doing it online in advance, and they're paying for either at least half or the majority of their stay up front and with their credit card. So you don't have to get into the collections business like I've spent the last 32 years having to be in as a result of owning a lot of real estate. Because, once you have a bad tenant, as John, I'm sure, knows very well, then it's about, how do I get that bad tenant out of my space? I got to take them to court. Judges don't like to throw tenants out of buildings. And you still have to pay the mortgage every single month to the bank. They don't care whether you're getting paid by your tenant or not. So the RV investing space is very refreshing because almost all these tenants are paying well in advance. So it actually helps the cash flow as opposed to what I'm used to from all my other previous investments.
Yeah, two quick comments there too is that we've only had one true eviction on any park. That's it. Only one time did we actually have to go to court to get somebody off property, which is pretty good, which is amazing. And then the other thing, especially to folks coming from Europe, I've heard this commented, is that an RV park is the infrastructure. Well, one thing we do to add value is tiny homes and cabins. And if you think about an RV spot, you can very easily, it's basically a pad and utilities that are ready made for a tiny home. And in the future, as we move to a world where there's less space available, especially folks from Europe, I believe, I have a friend from Germany, and he was very interested in this aspect of RV parks. We can add cabins and tiny homes as monthly rentals or nightly rentals, depending on the market. But it's almost as easy, there's nuance, as dropping one there. Like we've had a park where we've multiple times delivered tiny homes, set them down, and effectively plug them in and connect them, and you have a little house. It's really cool. And depending on the park, that can actually be a significant value add where it turns over time. You could have grand visions and say, oh, this could be a solution to affordable housing. Not entirely, but it is housing that is very needed. And it's a cool aspect of this asset class.
Yeah, it's interesting. I think maybe 4 or 5 years ago, one of the most famous Danish architects was part of a project. It's called Big Group, where they turned containers into houses.
Yep.
Students.
Yep.
So that's a big problem here and many other places for students to find affordable houses because the universities tend to be in the cities. And if you're in Denmark, it's Copenhagen. Most people would like to stay and find affordable houses is very difficult. So they started to build complete living areas from containers. So it's probably the size of an RV, I guess. So it makes sense, and they are stable. You can and you can put them anywhere. They build some very nicely out to the seaside because they can be removed again. So I can see some optionality there. And again, if it's a good location, it will always be attractive, I guess.
Mm-hmm.
So, but thank you guys. I mean, I can see if we have any more questions. That is not just related to taxes, but there's one here that where would you like to expand as you bring in more capital? So do you have a strategy? Rich, you just mentioned that you were already speaking with some other operators with 60, maybe 100 million, but do you have anything particular, let's say, geographically?
I think, well, first and foremost, right, it's real estate. So location, right? And, we like to focus on, locations that people want to stay there year round, as opposed to maybe, in some of the colder states where these parks shut down in October or November, and then they don't reopen until it gets warmer outside. And so, there's a trend out there for investing in what the country calls the smile states, from kind of the Pacific Northwest down through California, Arizona, Texas, Southeast where John is, and then kind of going Northeast. But, we're clearly focused on good parks that are well located, that might be by a university, by a national monument. It might be, easily accessible on a major interstate. And in a tax-friendly environment too, because taxes are, state by state, and the more you could save in taxes, the more the value will go up in the asset.
Yeah, makes sense. Fantastic. All right, but I think we covered a lot, and I hope we will see you guys again. We'd love to hear how it goes. I think it's a grand vision that you have, and I'm sure you're going to be successful in your operation. I am really impressed with what you have made in the last 2 years only. I mean, that's really impressive. So best of luck with it, guys, and thank you very much for joining us.
Yeah, thanks for your time. Nice to see you, Soren.
Well, thank you for having us.
And happy holidays to you, okay?
You as well.
Thank you so much.